Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to hit up a comment in the question section that I'm going to comment on and give you my opinions. Again, I view things maybe perhaps a little bit different than most others. I don't know why. It's just driven by data. I'll try to show you what I'm looking at and the data that I'm looking at so you guys can see what I'm seeing, at least, or understand my viewpoint. So let's dive into the question or the comment that this person has, and I will try to address it. So Joe says, so the 40-year decline in interest rates caused money to pile into stocks and bonds, but not real estate, question mark. I agree that high inventory precedes a housing crash, but we are for sure in a housing bubble. Housing is not a value like PM, which have gone nowhere in the past 10 years. I see increased inventory with the coming recession. So this is, I think, the way that I view it is vastly different than the way that everyone else is viewing it. Let me describe the differences in the way that I view it and the reasons why I view it a certain way. The general consensus, it seems like, is that a recession will cause interest rates, or a recession will cause housing market to go down. The general consensus is that interest rates, when they go up and down, is what causes home prices to go up and down. In my opinion, that those two things that I just stated are false. They are not true. The reason we've had a 40-year decline in interest rates is because the demographic was not a large demographic coming into home buying years. We had a slowing of growth of population, so that's the percent growth during that time frame. From a very tight period in the late 1970s, early 1980s, with interest rates very high, a large demographic came into home buying years all through the 40s, 50s, 60s, and 70s in a gigantic increasing interest rate environment time frame. Then we went into a decline in population growth, so that's the percent growth, and that relationship with the housing market did not drive loans into the system at a greater rate than where we were at in the 1970s and 1980s. So if you were to look at it, the housing starts went sideways and were stable. In the 1930s and 40s, we were at a very low housing starts build rate, and we jumped to an entirely new level in the 1970s based off of the demographic of the baby boomers. That increased the interest rates, that increased the inflation. So it wasn't the interest rate that caused the inflation. It was the inflation and the demographic coming through their lives, buying homes, increasing credit, and spending money at peak spending years, having kids and all that other stuff, that caused the conditions for interest rates to go up. So when we went into a different environment where that credit growth wasn't growing faster than it was before, it was going sideways. It was still growing, but it just wasn't growing at that fast of a rate. We also could catch up with GDP and energy and all that stuff as we grew into the entire world's capacity. We calmed down on inflation. We had employment that could get outsourced. There's a lot of things that were behind it as well that helped inflation be very tame. That low inflation, low interest rate environment caused money to rotate into. Actually, let's look at some charts, guys. Let's just go right in the charts. We can show you this. We can go to the S&P 500, and we can see these cycles over a long period of time. So here is the cycles here. These are commodity booms where your S&P 500 goes sideways in these basically three hump consolidation periods. Commodity boom, commodity boom, commodity boom, and we are entering, in my opinion, a commodity boom. Why are we entering a commodity boom? It's based off of credit expansion. It's based off of the cycle that we're in, and it's based off of the commodity to stock ratio. which is moving favorably for commodities. These are your three gigantic periods where you went sideways. These were housing boom areas. Housing boom, and we're in a housing boom. I don't know why people want to deny a housing boom. Even Powell admits to a housing boom because that's why interest rates, he's trying to hold them high to kill or slow down the inflation from the housing boom. They're all interconnected here, guys. Now, this here down here, this is a little bit of a different scenario. This is a deflationary bust, but it was also a commodity boom. And things got revalued in the 1930s. Gold was revalued, and that essentially revalued all of the commodities. So these periods in between were low interest rate environments for the most part, or were steady interest rate environments with a little bit lower inflation. And that's those three legs higher. This is a stair-stepping pattern that we see moving higher and higher. And I think we are entering a sideways motion in the S&P 500 for the next decade, based off of higher interest rates or higher interest rates and commodity outperformance, with the demographic coming in home buying years known as the millennials, which is basically the kids of the 1970s baby boomers. So they had a bunch of kids in the 70s and 80s. They all bought homes in the 70s and had kids in the 80s and 90s. So the inventory is a measurement of where we're at in this cycle. So if we were to go down and we were to look at some data here, all right, let's look at some data and get you guys some more data. So here's some data. We've got housing starts. So here's your housing starts, right? Let's get off log. So here's our housing starts. This is the commodity bull market from circle to circle, circle to circle, and then we've got circle to wherever. Here we had increasing inventory and very high inventory, which caused a bust. High inventory caused a bust. High inventory caused a bust. We don't have high inventory here. It's low inventory here where we're at. So what makes you think that this time it is going to be different? Now, if I yanked up Fred housing starts, and I'll show you through this here. This is privately owned housing starts. Here's your boom bust cycles. Now, it doesn't show inventory. If you notice, every time we start to decline in our housing starts, we get a recession. So decline in housing starts, recession, decline in housing starts, recession, decline in housing starts, recession, decline, recession, decline, recession. You can see once we go below the average, we basically get a recession every single time outside of this 2000 time period. A recession is brought about by housing starts declining. Why is that? It's because your construction spending, this is your total construction spending in residential, starts to decline and goes all the way back down to levels that are very low, and it causes a recession. So it's construction spending that kind of starts first. And we're obviously seeing a slowdown here in construction spending, but that doesn't mean it can't go back up. It's very dependent on interest rates and the affordability, but the demographic is there to buy it. It's the affordability that's holding it back at this exact second. Holding it back, it's slowing the move down. That's what Powell wants to do. He wants to slow it down. So we look at the U.S. construction and all employees. This is your employment that gets from the boom bust cycle. If you look, we had a big bust in construction employees at 2006 and onward. And that's where your recession comes from. It's the construction cycle spitting out unemployment. That's where we got a large move. We don't have that right now, guys. It's not here. We've got employees in construction are still going up. And if people continue to buy new homes, this employment will continue to go higher if the housing starts remain robust. And if we look at the housing starts, just to go back, we're at 1.4 million housing starts. It's just moving sideways. Yes, it's slowed down a little bit, but we're moving sideways and we're holding steady. The inventory of existing homes is very low. And if somebody wants to buy a house and they don't want to compete in the existing home market, they're going to have to buy a new home. That is what drives new home sales, is the lack of inventory of existing homes. So this is what we want to watch. We want to watch the housing starts to ensure that we have this moving in an uptrend. Then we want to look at the construction cycle and see if people are getting laid off. If they're getting laid off, it's going to cause a recession. We can also look at total construction spending in the United States. We can see that construction spending turned over. In 2006, it peaked. We came back down, and the recession occurred here, where we were coming back down. That also showed that employees were getting laid off in the construction cycle. So we had less spending, employees were getting laid off, and right now, we do not have that. We do not have less spending in construction. We do not have the employees getting laid off. Here's our employees. This peaked in 2006, turned in 2007, lower, and 2008 is where we had the crash. But employees were getting laid off. Notice that we had a slowdown in this metric in 2000, 2001, and 2 and 3. We slowed down and then we launched higher again. All of this matters. Right now, could this slow down and roll over? It very well could, but it's going to take time. It may take a year or two before that actually rolls over and we have a recession or crash in the system. Now, we very well could be, we'll call it, swiping away a bunch of garbage companies or loans or people who are dependent on low interest rates. We may have to flush out the system with those guys. And we could see a slowdown. We could see a recession from that aspect. But that does not mean that it's being driven by the real estate market. I find it hard to believe that we are going to have a real estate crash with no inventory. Tell me, if you're in there and you believe that we are going to crash, tell me how we are going to crash with any sort of we'll say, a crash that is going to be immediate with no inventory of homes. How are we going to crash? Now, I will say this. We do have an anomaly that is happening where we had home prices decline with inventory under 6 months of inventory. We've never seen that before. Never. It's an anomaly. And right now, looking at construction from employees, total spending, all of this stuff, I just don't see it. I don't see where this crash is necessarily going to happen in any sort of immediate time frame. What I would like to see first, if we are going to have a crash and it is caused by real estate, we will see inventories go up. What that means is that the demand for homes is going to be less than the supply. So tell me, how are we going to get the supply of homes above demand without building a bunch of homes? That's the question. If we're going to build a bunch of homes to go into a hyper supply phase, employees are going to go up or remain steady in the construction cycle. This will remain high in order to get the supply into the market. So how are we going to do this? How are we going to have a recession from the housing market where we have supply exceed demand? We have a hyper supply phase. This cycle starts to peak out and then starts to decline with unemployment going up from the construction cycle, et cetera, et cetera, et cetera. The other cycles is we will see tech employees and some of these other areas of employment get laid off due to increasing interest rates, due to people shifting spending towards the things they need away from technology and these other areas that they don't need. So people are going to start focusing more money on food, housing, energy. That's where the money's going to go to. That is the commodity bull market. That is the cycle. And it starts from a larger demographic coming into home buying years, increasing credit, things get more costly, and money and people shift in that economy. That is the cycle. It shifts away from technology and towards real things that people need. Now, that they want Netflix. They need a house. They need somewhere to live. They're gonna put more money towards rent and all those things. But that's what I'm seeing. That is what I see. I don't know what you guys are looking at in terms of data of where you think this big housing bubble is occurring. People are solely focusing on Case-Shiller price index. And the Shiller price index should go up 40% to account for the 40% increase in money supply. No one talks about that. You should do a money supply to house price ratio. Maybe that'll tell you perhaps the value of homes in relationship to the M2 money supply. Maybe I'll do that here eventually. But that's what I've got, guys. That's all I wanted to talk about. Give me a thumb up for the content, subscribe to the channel. And if you guys like my logic or thinking, if you agree, definitely join the website. Commodity bull market's coming, in my opinion. Money's going to shift. This economy is going to rotate towards commodities and real things versus technology and some of those other areas. All right, guys. We'll catch you later. This is Finding Value.